A lot of people are recently looking at General Motors. Their revenue has sharply risen since 2020, and they have been buying back shares like crazy. 15% share buybacks year over year so far. And with Trump coming into office and promising higher tariffs on foreign car manufacturers, maybe this is a buy. So let's look into it, why I think General Motors has some weaknesses. The most important thing about any company is the vehicles delivered. And we can see GM has sharply fallen since. North America makes up around half of the cars, but when you look at the revenue, international is a fraction. So when we look at the cars that GM sells internationally, they're very low price, they're not in the high price segments. You can also see this by the net income. Over the last 9 months, North America is where all the money was made. International practically does not matter. So technically, if you look at GM, you can write off international. Nothing has happened there. You can also see this by market share. North America has stayed kinda stable over time, dips here and there, but overall around 15%. Meanwhile, internationally, it has declined and declined and declined over time. GM internationally has disappeared. So this is what you need to watch out for, the North American deliveries. And they have declined since 2017 by 20%. Now, of course, they have recovered since 2020, it was worse before. This is also why the stock recovered so well. But North America is basically the only business for GM that matters and will continue to matter in the future. They're mentioning their improved performance in China. They want to give the impression that they're still internationally relevant. But they're not. In all these markets, even if they grow some revenue, it's not going to improve the bottom or top line. Everything you look for is North America. Here's where they have their pricing power. And you can see that. 20% decline in delivery since 2017, but revenue has exploded. Equals, they have raised prices extremely on the cars, and I think that's what you all noticed. New cars cost a hell of a lot of money nowadays. But what's concerning is, you can see this in the revenue that they've raised the prices sharply, but the gross profit has not really moved that much, honestly. Since 2017, it has kinda stayed the same. So that means they're not even making more money on their cars than they were before. Their gross margin sits around 12%. They were up to 14% before. Their manufacturing is extremely expensive. They cannot compete internationally with these Chinese companies. That is why they are only relevant in North America right now. They're just not competitive anywhere else. And one thing is also the debt. They have a lot of debt, 1 or 2 million. This is normal for auto manufacturers, but let's look a bit deeper into this debt. When we look at the long-term debt, it is basically all in the financial sector. So basically the part of a company where you lease and finance your car from GM. They do the financing, they do the leasing. Long-term debt, 76 billion, 35 billion short-term debt. Basically, all of the debt is in GM Financial. Now, of course, they have receivables of it. These are the car loans they have. And then equipment or operating leases. This heavy debt is not just like, oh, it costs this and this much to modernize your factories. This is all leverage in the financial segment. They're not making that much money in the financial segment, only 2 billion. Compared to the 11 billion automotive. But automotive mainly makes money because people get these cheaper auto loans from GM. Or the leases from GM. If GM Financial wouldn't have this huge amount of debt, wouldn't be able to lend out cars, wouldn't be able to issue these loans, then these automotives revenues would be way, way lower. But then there's a risk on this. Two risks. What if people default on their car loans? And what if the resale value of the leases? Because you have the option to either buy the vehicle after you lease it, or if you don't, GM will just sell it off as a secondary car. What if those used car prices go down? Currently, they're on an all-time high, and currently people are not defaulting on the loans. But interest rates are not coming down. The market actually anticipates no further rate cuts, sometimes even rate hikes. US bonds are extremely expensive right now. And this is the risk. If this blows up, that is a lot of money gone for GM. And then it also makes sense why GM has recently shot up. Trump is offering to make interest on car loans tax deductible, equals worth it for GM, more people will finance their car over those, more car sales. He's historically against high interest rates, he's gonna push the Fed to lower interest rates, so then also the interest rate on car loans would go down, equals more sales for GM. Meanwhile, as long as this market share in North America stays stable, and they're not getting attacked by cheap Chinese competitors, who crush them globally, globally, GM has lost market share and is still losing it, and especially Asia Pacific, China, etc. was a big hope for them. They've lost 50% of market share. North America is the only hope. As long as they can pass their very high costs onto consumer, it's good. So if Trump comes in and tariffs Chinese cars, tariffs European cars, tariffs everyone, then GM has a good chance. And then this net debt is not an issue. And other than then, the net income is fairly stable. Then you have at 5B. Then they can buy back 10 to 15% of shares each year. Now what is the risk? GM gets disrupted at home. If Americans aren't willing to pay these high car prices, and the government doesn't stop China from exporting their vehicles cheaply to America, then we will crash back to the $27 we didn't see long ago. So let's see, what am I willing to pay for GM right now? We cannot assume that revenue is going to continue to grow like the last few years. There's a ceiling on pricing. Even if North America gets completely shut off from foreign car makers, you can't pay infinite amount for a car. The economy and wages are not gonna grow at the same rate as car prices have grown over the last few years. Deliveries will continue to decline probably, even if the Trump administration helps car makers a lot. It has just happened in the past. It's gonna continue to happen unless GM can somehow massively cut its costs without leaving America, which I do not think is possible for them. This is why they're moving a lot of stuff to Mexico, which Trump wants to stop. I'm just assuming a stable market share, but that the deliveries over time are gonna decline, and that the prices can't keep up with the decline. However, I will just assume they're gonna buy back 10 to 12% of shares. In that case, the net income would decline by 2 to 4%. No matter how much you shut your industry off from the outside, it's gonna get disrupted. And I think this is where GM is heading. 10 multiple on that, which would be fairly high, honestly, but if a company doesn't have as many risks from the outside, $60 per share, in that case you have a 21% upside. But I don't really like this scenario, because there's always a risk that an administration after Trump could lift the barriers, foreign car manufacturers come in, and the company just gets destroyed. Now, what if it goes well? Basically, the net income doesn't decline. They buy a lot of shares back, maybe even revenue grows slightly, and then they get a 20 multiple on that. Well, in that case, you have a fantastic company which has turned around. They turned around, they lowered their manufacturing costs, and that is a great scenario. But I think this is very unlikely. GM is not able to lower its costs that much. And even if a slightest bit of competition comes in, car prices are going to be sent crashing down, and that risk the huge amount of loans they have on their books. So I want to be conservative. This is a scenario which I would follow. And yes, it seems highly ridiculous, but just imagine what happens. What happens if eventual Chinese manufacturers come in and disrupt you? What happens if gasoline completely goes away and GM stays behind Tesla? And the share buybacks go away as soon as a slight dip in car prices or deliveries happen. Up to a certain point, they have high fixed costs, but everything beyond that, they make a lot of money. A few years where deliveries are low can massively crush net income, even if deliveries dip just by a bit. And this is the risk here. So if deliveries go slightly down, these share buybacks go away, or they're not at very high levels. And this would be a scenario that has happened for some time, and might happen again. And in that case, $14 per share is not really good. Now, do I think this is gonna happen? Or the normal scenario is gonna happen? I think it's gonna be somewhere in between. But I do not really like a company that is only propped up by car prices in North America going up faster than wages, that is propped up by tariffs on foreign cars, and I think this time bomb. It could go very well, people are buying the cars, the share is being bought back, but eventually there's a ceiling. And I think this is a tsunami that will hit all at once. I don't think this will be gradually lifted by the Trump administration, bringing in more and more cars over time. I think this will hit one day from another. So I'm gonna pass on GM. At these prices, the risk is too high. I do not like car manufacturers that much anyway. What do you think about it? Write down below. Have a good day.